Ever wondered how wheat turns into Bitcoin? Futures contracts let you control price risk like a pro. In this video, we break down contracts, hedging, and Contango backwardation in plain English. Stick around till the end for a simple playbook to get you started.
Final thing for this week, we move into our educational topic. Again, we're talking about understanding futures contracts. We made an appearance obviously earlier in the show with copper, talking about that. Gary, let's get into the fifth and final thing. What do we need to know about futures contracts?
All right, so a futures contract, it sounds complicated. It's actually really, really simple. It is simply an agreement to buy or sell a commodity or financial instrument at a predetermined price on a predetermined date, a set date. That's it. So what you're doing is locking in the price today for a transaction that will happen later in time. Just like securities, the contracts are standardized and traded on regulated exchanges. So for example, Rob, you and I could have an agreement that says I'm going to sell you a certain amount of wheat on a certain date at a specified price. And that's all it is, right? And commodities are the most common underlying assets for futures contracts. The most common are things like wheat, metals, energy products, things like oil, gold, copper, we were talking about earlier in the show. But financial instruments can also serve as underlying assets. And in fact, even cryptocurrencies or Bitcoin, one of the ways that that companies were able to get the SEC to approve the Bitcoin ETFs was to say there are futures contracts. There's already a market in this. You might as well allow more standardized purchase of these things. So the key thing here is you do have a lot of speculators in these markets, but it's also important to understand that producers will use these kinds of instruments. So for example, like let's say I'm a farmer and I produce a certain amount of wheat. And let's say I need to lock in pricing and I'm worried that pricing will fall. So I would say, okay, Rob, I'm going to have wheat. Here's when I'm going to harvest it and I will deliver that wheat to you, on a certain date, but let's agree on the price. Now I want to lock that in because I don't want to be in a position where the price can move and I make money once a year. I'm going to lose that money. Right? Oil producers do this. You also have, like, as an example, companies like cruise lines, they regularly hedge out fuel costs. Right? They know they're going to need a certain amount of fuel oil to run their boats, to run their ships. And so what they'll do is they'll buy that in advance. They'll buy a few years out. They have a pretty good idea. So these are important instruments that companies can use to lock in profits, to ensure they don't lose money, to have future supply guarantees. We see it a lot in the uranium market as well. These aren't standardized things, but like Cameco has long-term supply agreements. They're effectively futures. They're just private, not publicly traded.
Makes sense. Gary, I know there's two important terms that we want to touch on in regards to futures markets, Contango as well as backwardation. Gary, let's start with what is Contango as it relates to futures markets? What is Contango?
Yeah, so it sounds complicated. Again, the reality is much more simple. Contango is simply when futures prices are higher than the current spot price. So, for example, if gold is trading at, $3,400, but a gold future is trading at $3,500, that's Contango saying we expect prices to rise. And then backwardation, so that one's hard to say. That's the opposite. That's when,
side.
Yes, exactly. There you go. That's when the market is expecting prices to decline in the future. You're saying, okay, the price today is here. The price tomorrow will be a little bit lower, or a month from now, or a year from now. That's what that is.
Great stuff there, Gary. That'll wrap up this.
Hang on,
sorry.
we're not wrapping. There's one other key thing here.
I missed it.
It's really important to understand. There is a hilarious example that every young trader is informed of. We are used to thinking of financial instruments as sort of these abstract things. You own shares in a company. You don't have to take delivery. But it's important to note that in most cases, futures actually are sold or bought on actual stuff, things. There's delivery involved. You need to know if you want to take delivery or not. And so every young trader is warned of the occasional story of someone thinking they had big profits in a futures contract. They only thought in terms of abstractions instead of physical goods. And then they didn't sell that contract before expiration. And then they got a phone call asking where they wanted some huge quantity of actual physical oil, wheat, or other goods delivered. Like, what do you mean? Yeah, you bought this, right? Now we're going to deliver it. I'm like, oh no, right? And so it's really important to know if you want delivery or not. If you're a cruise company, you probably want delivery. You probably want the oil. If you're a farmer, you intend to deliver the wheat. But if you're a speculator or just trading on something, you really want to sell that contract before expiration if you don't want to take delivery. And I remember back in, God, I think it was 2020, when oil prices went negative, I had people saying to me, well, wait, oil prices are negative. Why don't you buy it? I'm like, because I can't store it on my lawn. Like, you have to take delivery.